there can be compositional effects, is what we call them. So younger people coming in, lower wages, older people, higher wages, retiring can be an effect. I'm not sure it is right now, but I can check on that.
I think that's likely to be the case as we have increase in workforce participation. I think that's a likely consequence. You made a very important point, I think, earlier that sustained wage growth absolutely requires sustained productivity growth. It's not possible to have the former without the latter. We all know that productivity growth is driven by several things, but one of the principal contributing factors is capital expenditure. It's new tools and equipment and technology in the hands of workers that make them more productive. The June FOMC minutes included a disturbing observation, and I'll quote very briefly. It says, some districts indicated that plans for capital spending had been scaled back or postponed as a result of uncertainty over trade policy. So the FOMC is saying that there is already adverse consequence in the form of scaled back investment as a result of uncertainty in trade policy. If there's more uncertainty, and we have threats of additional tariffs hanging over the markets right now, doesn't it follow that this is a threat to wage growth? Because the continuum includes a reduction in capital expenditure, lower productivity growth than we would otherwise have, and a corresponding relative weakness in wage growth. So in other words, isn't all this trade uncertainty a threat to wage growth?
It may well be. We don't see it in the numbers yet, but we've heard a rising chorus of concern, which now begins to speak of actual capex plans being put on ice for the time being.
Yeah, which is really disturbing. The stagnant, to the senator from Tennessee's question about what causes stagnant wages, well, it corresponded to an extended period of very low productivity growth, which itself corresponded to very low capital expenditure growth. We broke that with the incentives in the tax reform that caused a big surge in capex, and it would be a tremendous pity to jeopardize that because of the trade policy. Let me move on to a somewhat technical matter regarding the Fed's balance sheet. As you know, historically, the Fed has manipulated just overnight rates, the discount rate and Fed funds rate, and let the markets decide all other interest rates. That all changed with quantitative easing when the Fed became the biggest market participant in the purchase of treasuries. And it changed in an explicit way when the Fed decided that it would intentionally manipulate the shape of the yield curve with the Operation Twist, which was very consciously and willfully designed to change the shape of the curve. My understanding is now, to the extent that you make purchases of treasuries, which you do when payments come back to the Fed in excess of what you want to run off, you do so basically as a set proportion of what the Treasury is issuing without regard to where on the curve they're issuing. So while this is happening, the yield curve is flattening in a pretty dramatic way, right? 2s, 10s were like 100 basis points a year ago. Today they're, I don't know, 25 basis points. Some people are concerned that a flattening curve or an inverted curve correlates with economic slowdown and recession. Here's my question. Does a dramatic change in the shape of the yield curve in any way influence the trajectory that you guys are on with respect to normalizing interest rates and the balance sheet?
In other words, are we going to change our balance sheet policies due to the, is that what you're asking, due to the changing shape of the curve?
Does the changing shape of the curve weigh into your considerations at all?
You know, I think what really matters is what the neutral rate of interest is. And I think people look at the shape of the curve because they think that there's a message in longer run rates, which reflect many things, but that longer run rates also tell us something, along with other things, about what the longer run neutral rate is. That's really, I think, why the slope of the yield curve matters. So I look directly at that rather than, in other words, if you raise short-term rates higher than long-term rates, then then maybe your policy's tighter than you think, or it's tight anyway. So I think the shape of the curve is something we've talked about quite a lot. Different people think about it different ways. Some people think about it more than others. I think about it as really the question being, what's that message from the longer run rate about neutral rates?
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.